A very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coghlan. I'm going to be getting us ready for the week ahead, and this is a very important meeting. So very good, warm welcome, Brian, Guy, Ignatius, Yanni, Kingsley. Great to see you. Good to have you back from Dubai, Kingsley. Hope you had a safe trip. And this is a very important webinar today because these kinds of markets are very easy markets to get sucked into trades, and you end up getting caught out completely the wrong side of the market. So I'm going to be explaining to you why that's so crucial. We're also going to look at some of these topics ahead, including on Wednesday. We'll be looking at the US PMI print, probably the best trading opportunity of the week. We'll also be checking out the RBNZ rate statement. Also looking at some crypto learning points, particularly with the market cover indicator, which I will share with you, and looking at some of the big opportunities that potentially might be coming, as well as looking at the big narrative, which is very, very crucial. I hope everyone can see my screen and hear my voice okay. That's great. Yeah, very important webinar today, and there's not much going on. Which is in one sense, which kind of makes this webinar more important. So let's just get the big picture absolutely straight in our heads. If we take a look at risk markets, you can just see, look at the trend. The trend has been tracking lower in global stock markets because markets are negative towards risk. We've got a stagflationary environment that we're more than likely heading into, with recession projected for the UK, the US and the Eurozone, and also COVID-19 woes weighing on Chinese sentiment. So the three world's largest trading blocks are either in a recession, heading towards a recession, or struggling with a global pandemic. And if we take a look at US stocks, you can just see S&P 500 has been tracking lower all year. The Dow, the NASDAQ, DAX, Euro stocks, all of them have been tracking lower. So the general perspective is we're expecting to find sellers on rallies higher at the moment. Now, why have we had this recent surge in US stocks and European stocks? Well, the answer has been, of course, because of that weak US CPI print we had. We saw that the US inflation dropped a little bit, and that gave some market participants, a little bit of hope that perhaps the Fed would either announce a pause or a pivot at the coming December meeting. We also saw chances of a December 75 basis point hike drop down to 50 basis points. And if we just take a look here at interest rate projections for the Federal Reserve, we can now see that market participants, there's an 81% chance of a 50 basis point rate hike at the Fed's next meeting on the 14th of December. And you can see since that weaker CPI print, markets have been pricing in a smaller CPI, a smaller rate hike from the Fed. So that's why we've got this recent uptick in stocks. But where are we? This is the important bit. Are we in a stage where we go, aha, yes, the Fed's definitely going to pivot? No, we're not there. We don't know if the Fed's going to definitely pivot. We don't know if inflation has definitely peaked. We've got the Fed's preferred measure of inflation on December the 1st, so that's going to be a key catalyst. We don't know exactly how companies' earnings are going. We're not 100% sure on the US housing market. There is no sense in which we have a clear sense in which the US financial economic activity is heading over the medium term. It's just not there. We don't have the clarity. So here is lesson number one. What do we do when we don't know? Well, what we do is we trade with short-term trading opportunities. I was speaking to Dale Pinker over at Face Analytics last week, and alongside Blake Morrow, I was saying, look, in these kind of markets, what I'm looking at doing is taking the short-term opportunities as they present themselves. So was there a short-term opportunity to buy the S&P 500 on that week's CPI print? Yes, there was. I bought the S&P 500, I bought gold, I also sold the dollar, and I've taken profit on all of those positions now, apart from a very small medium-term gold long that I've got running. And now I'm waiting for the next opportunity. Why? Because I don't know for certain that the Fed's going to pivot. I don't know if they're going to pause. And I don't know exactly what's going to happen with the US, the European economy. We've got Russian-Ukraine risk bobbling on in the background. We've got the COVID-19 response out of China. And although I don't think COVID-19 is going to be an issue for China in the next 12 months, the outlook for global growth is less certain in my perspective. So you put that all together and we can see the following, can't we? We can see, yes, the US dollar has been weakening recently after that latest US CPI print. And if we just take a look here and just take a look at the dollar, you'll see the dollar index has been tracking lower recently, just breaking through that trend line. Significant break on that trend line that we had. Okay, dollar weakening on expectations of a less aggressive Federal Reserve. We also saw that in the bond market. We saw US 10-year yields just pushing lower in the US bond market as bids came back into bonds, as market participants saw the attraction with 10-year yields up at that 4.2, 4.3%. So all of this is saying, yes, the market is anticipating and is positioning for a weaker dollar at the moment. Okay, that is the market bias. But is the position so certain and so sure that I would feel confident positioning over the medium term for a weaker dollar? No. Instead, what I'm looking at is trading short-term opportunities. Great, you've got it. That's the big picture. So now you've got that big picture, we'll start looking at the opportunities that we've got coming. But before we do, I wanted to share something with you called the magazine cover indicator. You'll see here that as I flick through my tabs, I've got the Economist's latest cover figure, which is for November the 19th edition. We have crypto's downfall. Now, the magazine cover indicator is basically a way of assessing global sentiment around certain instruments. So the general point of view is that when a commodity or an instrument is so widely spoken about, the majority of that move has already taken place. So it's sort of like if you're speaking to your non-trading friends and they start to speak to you about a certain commodity or instrument, you know that probably that is either the top of a bull market or the bottom of a bear market. So the magazine cover indicator is a sort of slightly tongue-in-cheek phrase which says by the time you have a major magazine indicating some significant direction into, crypto's downfall, basically saying that after the saga from the FTX exchange going bankrupt, that this is, is this a crisis of confidence in crypto? Is this kind of the end? So what's quite interesting here is oftentimes this can pick kind of bottoms or tops in markets. Now, my reason for bringing this up is not to say this is the bottom in Bitcoin, because obviously there are significant issues with Bitcoin, particularly over a general confidence crisis. But what it is to say is that often when you have markets so widely advertised as being either bullish or bearish, making the front page of a magazine like Time or The Economist, they're sort of mainstream, sort of popular kind of places to report. It's not your your hardcore investors. It's just your general Joe who's maybe got a slight eye on what's happening financially. And you just see here Bitcoin sold off heavily with that FTX crisis and is now sort of finding some kind of base. So is this a potential base for Bitcoin? That's something that's definitely worth considering. And should we suddenly see a pivot from the Fed, then it wouldn't be unreasonable to expect this to start seeing some basing action. So it's certainly something to be looking at. Now, I'm not long Bitcoin, I'm not buying Bitcoin, but what I wanted to point out to you is this magazine cover indicator. You can have a look at that and it's definitely something to look out for. Okay, right, now let's have a look at the calendar ahead. So today, very light on the calendar. There is nothing that's interesting me from a trading perspective, and the PPI print was a welcome relief to see some relief in the inflationary pressures for German producers. Is it going to change the outlook for the ECB? Very, very unlikely. If we look at the expectations for the ECB, we can see here that yes, the expectations have been increasing for a 75 basis point rate hike. We now see a 72% chance of a 75 basis point rate hike at the next meeting, with the terminal rate expected just to be under 3% for the current expectations. And is this going to change anything? No, there's nothing that's going to be changing from that PPI print. Does it massively take the pressure off the ECB? No, ECB speakers are expecting to keep hiking rates to control inflation. There was nothing tradable there out of the euro. We got Bank of England's Cunliffe speaking, nothing expected here. The autumn budget has been and gone pretty much as expected, and a lot of the bad news has been priced into the pound, and the pound is really going to continue to be dollar driven as we head into the year end, most likely. We got Australia's RBA Governor Lowe speaking, not expecting very much fireworks from there. Some Fed speak, which is likely to move markets a little bit as we head into Tuesday. And what the market wants to see is any indication of a Fed pivot, any indication of a Fed pause. Since the latest CPI print showed a little dip lower, we have seen a reaffirmation from the Federal Reserve that they will continue to hike interest rates to bring inflation under control. Any sense in which Mester, George, Bullard start sort of talking back those aggressive rate hike expectations, you expect that to weaken the dollar, support gold, support stocks, support the S&P 500 in the US. So watch out for that. Fed speaker starting from 4 o'clock tomorrow into sort of 8 o'clock. So there's a 4-hour period. Expect volatility across stocks. Canada's retail sales, if you just take a look at the CAD recently, we have been looking at a little bit of CAD weakness that started to creep in, and that's what we were expecting. And we saw the CPI, the last Canadian CPI print, just gave the CAD reasons to strengthen. But was it going to be changing the outlook for the Bank of Canada? No, because the Bank of Canada have projected a recession in the first half of 2023. So the last Canadian inflation print was a little bit high, but that was something that I was looking at fading. We faded that strength, and now we can see the CAD remaining sort of halfway in between that range from the recent CAD strength. CAD's sold off, and now we're sort of flat, excuse me, in that range. So the Canadian retail sale, the best opportunity here is likely to come if we get a really big miss in the data. So if we see retail sales missing and housing data missing, I'd expect that to weaken the CAD. So you could look to potentially trade the US dollar CAD higher with a little bit of US dollar strength coming into the market at the moment. If that remains, US dollar CAD upside on a CAD miss would be acceptable. We'd need to see a big miss in the data. So year on year, something below, 3.5%. We'd need to see the core moving below -1%, and we need to see retail sales below 1%, as well as housing prices dropping significantly. If we saw a collective miss across the board, then we could expect some further CAD weakness and potentially trading that against the US dollar if it's still strong. Tomorrow, US dollar CAD upside, that would be acceptable. On Wednesday, we had the RBNZ rate decision out overnight. Now, do check out my blog. I've done a little look ahead for the RBNZ rate decision. It should be up there on the blog for the focus of the week. It's not up there yet. It should be. Sometimes sometimes this can take a little bit of time to get up. I'll just Okay, it's playing out. Do check out the focus of the week.
China Central Bank.
It should be up for tomorrow, so if it shouldn't be up, sometimes I think it's up today. I think sometimes it doesn't always refresh on my page. So do check out the expectations for the RBNZ. But in brief, what I'm looking for is you can see the markets are expecting a 63% chance of 75 basis point hike, and the majority of economists are expecting a 75 basis point rate hike. You can see here that it's 3.5 at the moment, and it's expected to move up to 4.25%. So if there is like a shift from the RBNZ, they've been really quite hawkish. Their last interest rate meeting was more hawkish. They're expected to err on the hawkish side, 75 basis points. Expect that to be communicated with more aggressive action, but the housing market's starting to slow. So on my focus of the week, I draw attention to the slowing housing market. So if we see the RBNZ, if they hike by 50 basis points, okay, and if they start talking about the slowing housing market, then I expect the New Zealand dollar to weaken, and I would look at Aussie New Zealand dollar strength. So the best opportunity would come from a dovish RBNZ, because they're quite hawkish. They're expected to be hawkish. Most economists expect them to hike by 75 basis points, but this is much more split than you might think. So it's a much closer call in terms of what's expected. And if you look at the interest rate expectations, you know, it's sort of almost 60-40, whether it's 50 or 75 basis points. So the hike is not going to be as important as the forward communication, the forward guidance. So what you're looking for here is a 50 basis points hike, and you must have this as well, which is a more dovish outlook. That would result in New Zealand dollar weakness, and I would favour that Aussie New Zealand dollar longs. That is an opportunity of the week. It's definitely one to look at. Just take a quick look at Aussie New Zealand dollar from a technical perspective and just see if there's anything grabbing me here. Well, yeah, there is. So what will be attractive here? If you just notice, there could potentially be a decent swing trade here. You see this 100, 200 exponential moving average. This is like heavy support. So typically, you'd expect this to work as support. So if the RBNZ are more dovish, hike by only 50 basis points, it wouldn't be unreasonable to see a move back up to that 1.100 area. So I would anticipate a move back up to that 1.100 area on a dovish RBNZ, and then stops could be fairly, easily anchored just underneath that 200 exponential moving average. So just sub 1.0750 should be absolutely fine, as long as you get 50 basis point hike plus the more dovish outlook. And if you're any doubt, just use the bond yield spread to check it out. So just check out the Australian New Zealand dollar 10-year bond yield spread, and that can give you a good indication of what's going on in terms of bond yields. And bond traders are very, they tend to be very reliable in terms of what's going on with interest rate expectations. And if you just take a look here, you can see that the Aussie, the Aussie New Zealand dollar 10-year bond yield spread tracks price quite accurately. So what you want to see, if you're not sure about whether the communication, you want to see the yield spreads, spike significantly higher, and ideally you want to see it sort of break out of this near-term trend line. So you want to see the 10-year yield spread break higher, and that would indicate that this has got to run potentially up to 1.1000. So that's what to look for. RBNZ. RBNZ, it is a interest rate decision that's worth looking at. If you miss the decision because you're in the UK, you're asleep, fancy getting up at 1 AM, whatever, then the simplest thing to do is to look for a retracement and using a daily pivot point, something like that. Then we've got a series of PMI prints coming out for the Eurozone and the UK. Now, this is tricky. We may see some movement here, but I think there's so many mixed drivers with the Eurozone. I'm not got high expectations for this at all. We've got the Russian-Ukraine crisis, the energy crisis, Eurozone expected to head into a recession. We know all that already, so a print to the downside is unlikely to surprise. The best opportunity would probably come from a big beat to the upside. So if we saw, PMIs coming in well above 52.2 for France, Germany above, 46, anything into 50 would be, fantastic. The Eurozone, anything, if we started seeing those at 50, if we saw an en masse move higher in the Eurozone PMIs, and I expect that to support the euro. And I'd be looking at trading probably the euro-US dollar pair. That would be my go-to pair. But I'd have to see a stunning en masse beat. I'm now talking about everything. And remember, the euro will start moving from 8.15. So this is not an event to wait, come at 9 o'clock and say, well, let me check what the Eurozone PMIs are. You forget it. You're going to miss the move. France, it starts moving from the French data point, and then it heads into the German data point. So once the German data point is out, then that's really set the tone. Germany's the largest mover in the Eurozone. It's the biggest contributor to the Eurozone. And so what happens in Germany lifts the Eurozone's boat as a whole, if you know what I mean. This is the tide that lifts them all. So watch out for that. And then UK print as well. Again, a lot of bad news priced into the pound. Even a good print to the upside is unlikely to move UK markets. Pound really going to be dollar driven is my conviction at the moment. So again, not expecting anything from the UK PMI outlooks. However, US prints, PMI prints, yes, I do see opportunities here. Best opportunity will come from a big miss. So what I'm looking for is global manufacturing PMI sub 49.5, global services sub 47, and the composite sub 48.2. I want to see it come in below the prior reading. If I get that and an en masse miss, and I get the US Michigan consumer expectations dropping lower as well, and I see inflation expectations, I want to see them move lower, below 5%. I want to see the 5 years move lower, below 3%. So if I get those about 2.9%, so I want to see a miss across the board for the PMIs, and at the same time, I also would want to see a miss in the sentiment expectations, and I want to see inflation moving lower, because that can mean the Fed can do less. If I see a miss in the PMIs, but I see inflation moving higher, it's a mixed outlook, and I'm not interested in a trade, or I'm going to be very short-term trade. So what you're looking for here, miss in the US data, miss in the consumer expectation. Remember, this is the final reading. We already had the prior reading. This is the final reading. And remember that 5-year inflation expectations freaked markets out of it because it went up to 3% from 2.9. So in other words, longer term, US consumers are seeing inflation being more in the system, more a problem to deal with over the long term. And that is meaning the Fed will have to do more. So it's negative for stocks because the Fed will have to be more aggressive. What I see is that below 2.9%, the 1 year below 5%, miss across the board, miss across the board. Okay, then if I get that, I'm looking at buying the S&P 500. I'd expect another leg higher in S&P 500, certainly for the day, maybe a couple of days. I expect gold to rise higher. I'd also expect the euro-US dollar pair to move higher. And depending what the RBNZ do, you might want to pair it with the New Zealand dollar, depending on that. So if the RBNZ are really, really hawkish, then New Zealand US dollar upside on a big miss across the board will make sense here. Okay, best opportunity of the day is it, and I'll be covering that live on Wednesday. So do come back on Wednesday. I'll get us totally ready for that. Don't worry, we'll be all over it. Thursday, BOEs, Ramsden and Pill does have potential to move the pound. Again, what the Bank of England have basically done, and I'm heading up to London later today. I may pop by the Bank of England. Actually, they've got a nice museum there. I might poke my nose in there. What the Bank of England have done is they've put the emphasis on the UK government to start controlling inflation. That's the whole point of the autumn budget. It's meant to be naturally just tempering UK demand. So the Bank of England have essentially put the kick the ball to the UK government. So I'm expecting a little less impact from Bank of England. But what that does mean is they start taking the ball back and start making significant comments about inflation and the Bank of England's next interest rate decision in December, then watch out for that to move the pound. But got a series of Bank of England speakers. Do check out my blog, not my blog, check out the HYCM blog, of which I'm the main contributor on the central bank aspects. So that is here, just check out there and just look on the Central Bank Watch and you can see, what the Bank of England's doing. You can see, the latest expectations as well as the latest meetings all covered there. Heading into Friday, a very, very quiet end of the week. So there's really not much going on this week. Really, all there is this Wednesday with the RBNZ and the PMI prints. They're the best opportunity. I'm not expecting big moves this week, but if the moves are going to come, they're likely to come on Wednesday. So remember what I said, in these kinds of markets, what you want to do is you just want to wait. Short term, take the opportunities and then reset. That's what I'm doing. I'm flat. All my sort of short to medium term positions are virtually all completely flat. I've got nothing going on. I'm waiting. There's so much uncertainty out there. And so if you're thinking, first of all, if you think yourself, oh gosh, I don't know what direction the markets are going, that's normal. That's where we're at. We're at an uncertain stage. And realizing that is crucial. Once you've understood that, then when you see the short-term dynamics that push the narrative one way or other, we know how to get in on it. If you're not sure, come back on Wednesday and I'll run us through that US PMI print. That's the best opportunity, and that's what I'm sort of keeping my powder dry for this week. Okay, folks, it's been a pleasure. I'm glad I've been able to do this webinar today because it's an important time when you're able to say, this is a confusing time and stick with the short-term narratives. Folks, don't get sucked into unnecessary trades. Look forward to seeing you on Wednesday and take care. Yeah, Max, you're very welcome. I love sharing weeks like this because it's confusing. There's very little information on the data front. And so this is when you want to be the wise trader that just sits back, because trust me, when it becomes clear what's happening, the market will shift. Yeah, RBNZ, definitely. US PMI on Wednesday. It's all about Wednesday this week, as well as any other, Russian-Ukraine crisis. If you suddenly got Russian-Ukraine crisis ending, pound-euro longs would be great. And end of COVID-19, China 50 would be great. So there's some sort of things to keep in the back of your mind, but keep your powder dry. Folks, thank you all very much. Take care. Have a great rest of the week. I'm heading down to London today and look forward to being back here at my desk for Wednesday. Take care, everyone now. Goodbye.